Okay, everybody, here we go. Back together at last, surrounded with little puffs of loveliness. You know how it works. Look, I have a lot of stuff I want to talk to you about because it's just so sick. One has to laugh. Okay, so it is Friday. Thank goodness it's Friday, January 10th, 2020. Stocks finished lower across the board. Nothing major, but I want to show you something yet again because again, we have a lot to talk about. This is the debt market. All that red, the entire curve, yield curve dropped. How does that happen? By cash going into the debt market. Now, if you notice, whether stocks go up, the yield curve flattens out. Whether stocks go down, the yield curve flattens out. Understand what you are looking at. This is not normal. This is not how markets function. That no matter what, the debt market, though the entire yield curve continues to flatten out. There is an enormous amount of effort in place right now to keep the yield curve from inverting yet again. Now, it's pretty simple. The Federal Reserve continues to pump hundreds upon hundreds upon hundreds of billions of dollars into their repo operation, which is a scam. I'll cover it real quick. The Federal Reserve is involved with the major Wall Street banks moving cash from one institution to another institution. This is tens of billions overnight. Last night was 83 billion, just as an example. They're doing this every night, over and over again. Now, what this is doing is keeping the extreme short end of the yield curve pinned down. All right. It also gives the illusion of liquidity in the market. We're drying up. Okay. This is why vastly more amounts of debt are going to be piled on to the backbone of the United States and its citizens. Understand, that must happen. It's the debt-based economic model. It demands cash be borrowed from the future in greater and greater amounts just to sustain where we are. It's the law of diminishing returns. It's very simple. So, back to where I was going with this. So the Fed is involved in the repo scam to pin the yield curve down. The entire curve is flattening out, dropping, okay? And if the Fed were not doing what it is with the Wall Street banks to pin the short end of the yield curve down, I mean, this is what would happen, right? The yield curve right now looks like this. Bing! It would completely invert. Vast amounts of capital would leave the stock market like you have no idea. It's a freaking bubble. And I want to talk more about that. You know the market's a bubble. The stock market is a bubble built on the back of a monster. A monster like the world has never seen before. The debt bubble is a monster. It's engulfing the earth. It's going to swallow the earth. And everyone on the planet, no matter where you live, is going to suffer when the debt bubble bursts. But we have not seen anything yet, people. The repo scam is going to be vastly increased. Vastly. It must be vastly increased. What we're seeing with regard to the entire yield curve dropping, flattening out, no matter if stocks go up or down, that will also need to be vastly increased. It's debt fueled. Understand, what we're witnessing now, we've never seen. This makes what happened during the crash under President Obama look like a joke, what we're witnessing here. To prop this up, to keep the illusion real. You understand? So, in my view, not only are we about to see a Fed go supernova, which they're doing under the table, all right? They're buying the entire all the debt market. This is why the yield curve is flattening out. It's falling. All that red on the screen I showed you. The repo operation will be expanded on exponentially. And the mechanism is very simple. Suppress rates, force cash into the stock market. There's a fly in the ointment, people. There's a fly in the ointment here, and you know what it is already. It's crude oil. Crude oil, since the Middle East war got called off, or whatever you want to call it, put on the back burner for now. I have no idea what's going on over there. I do know this. If they do not, and they will, manage to prop up crude oil, stocks will drop. Stocks will drop. The entire energy sector is dependent on it, and the financial sector is dependent on it. The two largest sectors of the market is dependent on crude oil being up higher. So we did have a sell-off in crude today. I explained to you this was likely. We were more than likely going to see this. After that big sell-off, I said I would not be surprised to see it drop a little bit more. But mark my words, an event is about to occur soon that's going to prop it right back up. It needs to be propped up. And that's another thing that has no bearing on reality. The price of crude oil should be less than half of what it is today. It's fake, along with everything else. The fake data, the distractions, the look here, don't look here. Now, understand what you're looking at. Companies' earnings are going nowhere. They're flat, all right, despite the booming economy. You know it's booming because the president said so. Anyway, so what we're witnessing here, and I've alluded to this before, is a multiple expansion. That means simply this. Investors are willing to pay more for a share of stock in a company whose earnings are going nowhere. This, people, is a bubble. It's the definition of a bubble, as a matter of fact. So, I'm sorry, my nose is really itchy. Itchy nose. Anyway, so understanding, and this should make absolute sense to you, okay? The Federal Reserve is pumping the debt market like we've never seen before, and it never gets a single mention, not one, from the President of the United States. The silence is deafening, should be to you as well. All we hear about is we're booming. And all he does is tout the stock market every time it hits a new record high. And new record highs are coming. Now, I am not saying that this market isn't about to give a little bit back. Do I hope it does? Absolutely, I hope it does. I said that in December. And the market will make new highs. Why? It's a debt-fueled bubble on some kind of a freakish multiple expansion euphoria. That's what's driving the market right now. It's not real. It's the price action of this stock market, which is a derivative of the debt market, has no bearing, zero, on reality. That means expect stocks to inflate along with the debt bubble, which is hyperinflating. It's so simple. All right. Now, what does this mean for other assets? Cryptocurrencies quote a nice bid today. Metals quote a bid, but I still fully believe the price suppression mechanism with regard to metals, with regard to cryptocurrencies, is going to be in full swing. It's going to be in full swing. Let me say this too. As far as I'm concerned, metals, especially silver, the most undervalued asset on the planet Earth, okay? Cryptocurrencies, in the aggregate, all the big ones are massively undervalued. Again, in my opinion, you can have yours. I know I'm going to take heat for it, but you can have your opinion. You're entitled to it, and I believe I am too. In the long run, I guess we'll see who's right here. Anyway, it goes back to what I'm saying. You want to be in the dollar? Good. Be in the dollar right now. I think you need to be out of the dollar, despite the fact that it continues to gain some strength. Here, why? Global uncertainty. Yeah, who knows? Who knows what's going to happen? Because something is going to happen here to prop crude up, to push the entire energy sector higher, to push the financial sector higher. So easy, so simple, and it makes our job as people who are trying to wade our way through this, the dog shit, all right? We know what to do. We know what to do from every freaking aspect of this market you can dream about, period. And that's why I love doing this, why I love being here. I like making you aware of the situation and put it together in a way that you're not going to hear anywhere else. Should make sense to you what is going on, what's about to happen. The Federal Reserve has no choice but to vastly increase its repo operation, vastly increase its purchases across the entire spectrum of asset class, of the yield curve, and cut rates. Yeah, you heard that right. The Fed, despite what's coming out of their mouth, will be cutting rates. Despite the fact that we're hearing we're in a booming economy too. Oh yeah, we need to cut rates. We need them in the negative. That's the president. Remember? Repeat it over and over and over and over. Oh yeah. And every time members of the Federal Reserve hear that, they spray all over their shorts. Oh, they love it because that means they get to issue more debt. Central banks want to issue more debt. It's their end game. It's their final solution. The more debt they issue, the stronger they become. They fulfill their plan, multi-decade plan, to be the lenders and buyers of last resort. Do you see how simple this is? Very easy. Greg makes it easy for everybody. Look, it's Friday, people. It is Friday. I love all of you. That's the truth. And I'm going to leave you off with my favorite 3 things, people. Favorite 3 freaking things. Are you ready for it? Love each other, care about each other, and be charitable. Please adopt this kind of a mentality, and we will all be better off. I'll see you. You know something? This weekend is going to be very tough for me to do markets, a look ahead. But I will try to get one out Sunday. I will try. No promises, but I will try. I promise. Love you a lot. Share the video. If I don't see you Sunday, I'll see you Monday morning.